The title of the show is Lines and Numbers.
The title is Ideas and Aims of Project. Cycles exist, and a difference, a line of distinction exists between the random and the predictable cycle. The assignment is find that line of distinction. And this work, this show at the ACA, what is it, the Acadiana Council for the Arts, here this work on display is the study of the geometry of cycles and moods in the financial markets. And this was the table of contents.
And you are?
Alfred J. Stahl, A.J.Stahl, in New Orleans. I was known as Jerry, here in Lafayette, A.J. And really it's a great display that they made. The curators get the credit. I never thought any of these that were in a closet would be raised up. And that's like from 00, in the year 2000, that's the Iraq War, and then up there in the year 07, and so forth. And they're different time frames.
What I'm going to do is I'm just going to start filming, and we're going to just pick up whatever you say, right?
Fine.
And I'll go back through
I'll
and
be
just edit.
talking.
Right.
Yes. Tell me when you click it so I can begin. I'm going to just be
You're too late. I'm already running.
Well, that's great. Listen, this is the recent. Every one of these is a day. Posted here. All the reds are Mondays just to help the eye, so you can.
Okay, all the reds lines.
Red lines,
Okay.
here. So that's 5 days, 5.
And what dates are we talking about right in there?
Well, watch this distance. It'll give you a clue. This is, you can see, July, August, September, October, end of the year, and now here's January, February. Each line is a day. So this gives you a picture, for example, of the year of 2013. Here's January start of 2013, and this is the end, and then all of 14. And most people think that there are 12 months to a year. They're really...
And you don't think there's 12 months?
There are not 12 months a year in terms of market, capturing the market in proper time frames.
Huh.
So you say, well, how can that be? It's very simple. There are 52 weeks in a year.
Right.
5 days to a week is 260 business trading days.
Right.
The 260, though, less the holidays, is 250 days.
Right.
So
okay.
then you have 10 frames of 25 days. 25 days. And those are the 10 months of this sort, which there are maybe only 2.
So you're basically dealing with market days.
Trading days, market when they are open. So by framing the market in terms of these 10 segments, you have what I define as a month,
right?
Which is 25 events,
right,
in each frame.
Okay.
So when you post, people will ask a question: is the market going up or down? You really can't answer that question because on a 10-year period of time, the market might be going up.
Right.
In 5-year period, it might be going down.
So the monthly, the weekly, the daily, the hourly, and the minute, each one can be in a different phase. You might be up in one, down in the other, up in the next, and as you scale down, zoom in, and look at a shorter time frame, it has, so to speak, a life of its own and is not related to the 12-year cycle.
Right.
Or the 1-year cycle.
Okay. Now, what you're doing is really technical.
This is
way of
strictly
looking
technical.
at the market.
And you know, there are two, they can't argue. They're two separate realms, the technical and the fundamental. The fundamental is looking at earnings and health of a company, the field that they're in, the earnings, management, book value. Technical does not care about any of that and looks at none of that.
Right.
It's looking at the behavior of the market and the appeal that the market has by virtue of its movement.
So is it fair to say that they mainly do charting, that they do this kind of grafting?
There are different ways, some by charts, some by algorithms, moving averages, Bollinger Bands. There are many fancy technical names.
Right.
And the difficulty is when you have moving averages, well, when the short-term moving average moves up and the long-term moving average is down, there are many interpretations of which one prevails.
Right.
Because the short-term might go up and then be dragged down by the long-term. And they have different names called, like I think one of them is called the death cross, when the short-term average crosses the long-term and they both turn up.
So these are different sort of charting patterns you see on
this is a personal thing that different people will apply different yardsticks. I maintain that there are certain relationships between a short-term moving average and a long-term moving average that has more weight, carries more significance, and that's the setup is a full life is 125 events. You say a full life. Well, you have a chart, a pattern where there are 125 events, and it can be 125 events where the high-low is monthly, and that'll give you 12 and a half years. You can have 125 events where it's weekly, and that would be 2.5 years.
I see.
If there are 50 weeklies in a year of what I described earlier, then 2.5 years would be 50, 50, and 25 would be 125 events. So that would give you a 2.5 year time frame where the event is 1 week. Or you can do 125 events that are daily, and that'll give you 1/2 year because there are 250 events in a year. There are 5 to each month. We said there are 10 months, 5 to a month, that's 50.5 years would be.
Let me.
Anyway, that's rather technical.
So this is not what a chartist.
Yeah, right. A chartist does not do this. He operates, as I said. Are you beginning yet, or?
Yeah, it's going.
So you're asking how can how can this be called not chartist? How is that possible? A chartist operates differently. A chartist draws lines after the fact. When the market moves up, down, they connect those points, peak lows and peak highs, and they construct a channel. The difference here is these are all, and I'm pointing here and here, these are pre-drawn lines. And this is a 1-for-1, rise to the run, 45 slope. This is a half speed, and
and so is this. It's a 45. This is a
So you'll pick out certain points
Well, we
on
cheat,
your graph
so to
and
speak.
draw your straight lines from there ahead of what the market
We don't
performance
pick
is.
it out. It dictates, once a low is made, and then it rises sufficiently, as right here. I don't know if this can be
Yeah, I'm getting that.
visually there. That at this point, you can say this is a significant low. And the lines and all the lines are drawn at that
So
point.
you draw them at that point, yeah.
At that point.
At that time.
Then, how the market behaves and courses through these pre-drawn lines and responds to those lines, such as here. This pre-drawn line, how the market was found a ceiling here in this channel. Meanwhile, that's technical, and you can have 100 different chartists with 100 different charts and 100 different time frames, and the scaling, each 45-degree line will be different. So the approach is what is the correct scale, the correct ratio, proportion between price and time, distance, space, amplitude, and time.
Right.
And most of us ignore the significance of the length of time it takes for a move. Usually people will say, well, I made 50% of my money, I doubled my money, I tripled my money. They never speak of how long it took. That's a whole different topic.
Right. So I would imagine a lot of people also would like to know how much of a predictive value does this have, and that can you sort of tell where the market is going to go a few days ahead or a week ahead? Is it very valuable in that manner?
Well, its value, not so much that, is it points to future moments in time that are pregnant with possibility. If the market behaves a certain way at this future moment in time, such as there's a moment in time here where this line is saying, if the market arrives at that precise moment of time at an extreme low or an extreme high, that it will reverse. And that's, some say, the Coke syrup of this. So you really don't know at that future moment in time how the market will arrive. Will it arrive at a low point, or will it be at a high point? And if it's somewhere in between, then you know nothing. There is no trigger. There is no position to be taken. So this work is an attempt to verify whether these principles have any validity. And this is not my own creation. I tend not to use that word. Man can't create anything. He can structure, he can organize, he can rearrange, he can make connections between this and that. He can see the relationship between this and that. He can discover and in that sense, I do not call that, it's miracle enough. It doesn't have to be called creating. That's a strict interpretation of the word. Meanwhile, this work is standing on the shoulders of a man, turn of the century, who was a master of his day and a legend now, who applied these principles. And I'm claiming that I've found a tiny sliver of a perception on an approach that he was taking, and my aim was to verify whether it was sound or not. And my further claim is that some of the largest moneyed interests in the world are viewing the market in this fashion. And so it's a tiny window on a way of detecting market moments that are significant.
Right. Are you able to use this method and advise people as to when they might purchase, when they might sell, or do you work as a money manager or a person that makes advice to people who are investing?
I haven't done that. This is I've used the word a more closeted approach, though there are people who know me well enough to ask, wonder what the market's doing, or is anything coming up soon, and that might be significant. The answer is generally no. And actually, I had set all this work aside for quite a few years, and only recently, in the last several years, wanted to see if this was still behaving, observing the pre-drawn lines, and there was such a moment. Let's see, I'm looking at it upside down here. Right here, there's a moment in time that identified the high that was made at the end of the year. I don't know if you can see that. There's a pre-drawn square here. And, well, that's a detail.
So you draw out these straight lines from highs and lows that the market makes, and they kind of go out in time ahead of you a bit.
That's correct. And then the market will course through that as it did here. When this low was made, these pre-drawn lines and this square was in place, and
then after a few days, you get to see how accurate it all turned out and how predictive it was.
Whether it's responding to the dictates of these relationships, these pre-drawn lines, and given moments of time in the future where it was set at this halfway point that if the market was at an all-time high, that it would turn around and go down. And it did at the end of the year. That was a stunning confirmation. It doesn't easily tell you when to get out, but that's another subject. It's easier to get in than it is to exit a position. So that's see, this is when the market created the 9/11. It says Twin Towers, and the words "that man, no help, no rescue."
Okay, do me a favor. Talk about the .com again. Point to it.
Oh, right here. This is the historic high in 00 that was made in March. And you can see when the Iraq War came, what happened when it finally, that's further over in the darker.
Okay, so this dark area right here.
The dark area is when this ended.
That's the Iraq War.
That's the Iraq low, that low point. The third one. And when it finally rose above, then new lines were drawn ahead of time, all the way into the future, a year or two. All right. This ended the downward channel when it finally came through, and at this point, the authority to draw in these 45-degree lines was given, and they had drawn out a year and 2 years in front of the market. And as you can see, these pre-drawn squares, at this point, you see right here? We knew what time of day market qualified by being at the highest price from the low. It was, at that point, a sale. We did not know if the market would come and be at a low, or be somewhere in here, or
did not know. However, when it arrived and qualified by being at an extreme price, that was a signal that that phase, price and time, had been reached, and that the market would come down.
All right.
And would not go any higher for a period.
Is that related to any social or historical political events that we might have heard of?
That brings in the question of the technical and the fundamental. Is the market driven more by the news or by the mood? And my conclusion is the market is driven more by the mood, not by the news or an event. An event is an excuse after the fact, and I guess the best example is so often the market will end going down on good news, and on bad news it'll go up.
Yeah, right.
It's quite counterintuitive, and there's an old saying, buy the bad news and sell on the good news when it's publicly released. And when people are all enthused and confidence is in extreme, it means everybody is already in, and there are less buyers left, and the market is likely going to correct and go down, and vice versa. Well, there are a lot of cliches around, and there's always, there's nearly always a contradiction to one cliche or another. And you were asking me about what does it mean to pay up. Big money doesn't want to buy a thing cheap. People think you buy low, sell high. Not so, not necessarily so. Big money wants proof. They don't want to gamble buying at a low point that could go lower and lower. And here, evidence that the market has turned. They'd rather pay a higher price and feel that the worst is behind than to gamble buying cheap. It's a strange notion. It's, well, we understand it in this sense. They want evidence that a investment in a business is proven. They want to see that there is a success that's been tested, and pay a higher price. Instead of trying to steal a company for $100,000, they wouldn't mind paying $2 or $3 million if it's a proven success. And it's the same thing with the market. At this level, the market has demonstrated these lows look like the low point for a while until here. This is a technical moment that we pointed to earlier at the end of this square. It's at a high. And these are posted every day. Each red line is a Monday, just to help the eye. This is the end of '03. And from here, you can see the market continues higher. And constantly looking for signals when the market behaves in a way that signals the end of a phase. We're dealing with price and time. When do they run out? These are hourly, minute postings, weekly, monthly. This is another that's counting the passage of time. This is, as it says here, this is 13 trading days and 19 calendar days. And it says how many points it moved, how many minutes it took. 361, which is the square of 19, something, as you can see, the radical sign. People look at, and you want to be looking at things that large moneyed interests are looking at. Whether they're valid or not is beside the point. If people are responding to certain signals, then it's important. One of them is if 49 days has passed from this high to this low, that's the square of 7, or 81, the square of 9. Some people consider that extremely significant, particularly odd numbers, 7, 9, 11, which would be 121 days. And those are technical, rather obscure, not ever written about in any technical journals that analyze the market, and it really smacks of sham and charlatanism, frankly. Though there is some great sense behind it, such as, for example, the 7-year principle and the number 7, its significance. 00 to 07 bubble high was 7 years. 07 to the current recent highs was a 7-year. That's a broad brush stroke and has little significance. Now the computers, they'll have 50 different metrics in the algorithm that if the market does this, and enough of those signal points are met, it's all probabilities now with computers. And
did you use any computers for doing this?
This work is all done by hand. There are no computers, and it's and people say this could be computerized. Well, it would take thousands of man-hours to write the code, and that's not going to happen.
And how long have you been doing this kind of chart?
Well, this is off and on for the last 50 years, more thoroughly since the early 80s. And really, this is nothing more than somebody recording doing an EKG by hand. And over time, there'll be a lot of paper and ink spilled. As I said earlier, this is mainly an attempt to validate and verify some of the obscure principles that W.D. Gann came up with, wrote about in parable form. It was not understood by many. His work was really little understood.